Thank you for coming online for another session on financial management. So last week we covered value at risk. Any questions on that? And so we're going to stick with statistics this week also. If you are given $100 million, right? If you're given to manage $100 million, where will you put your money? How will you invest the $100 million? If investors come to you and give you, let's say, 10 to 15 investors, right? Pool some funds and give you to manage $100 million. Now, these investors can have different intentions. They might want to invest for the long term. Some might be actually yield seekers. The others might be professionals who have no time to manage their own funds. They might not have expertise in fund management. Maybe someone like doctors, engineers, lawyers, right? They are busy professionals. They lack enough time. They have busy schedules to manage funds. And so they might assign a fund manager to go ahead and manage funds on their behalf. Now, if that is the case, and the fund manager gets to collect $100 million, where will he invest? Will he put the entire 100 million in one asset? Let's say 100 million invested in US government bonds, or the entire 100 million invested in Sri Lanka sovereign bonds, or the entire 100 million invested in a commodity, maybe gold. How would you manage this? The most important thing is that if you have 100 million rupees, where will you invest 100 million rupees? You won't invest the entire thing, 100%, the entire 100 million in real estate, right? Or the entire 100 million in fixed deposits, or in treasury bills, bonds, or in stocks. You will split it. You will split your assets into, you will split the 100 million into various assets, right? So the 100 million will get allocated amongst several assets, maybe real estate, right? Perhaps FDs, then fixed income, or gold, let's say precious metals, maybe equity, or unit trusts, right? In various instruments. So if you had selected about 6, now these are instruments which have common features, right? So unit trust, there are common features amongst unit trusts. Now it's a unit trust is a company which manages funds on behalf of investors, right? So you can go and put your money in unit trusts. And real estate is where you buy property. FDs offered by banks or finance companies, bonds and debentures, precious metals can be gold, silver, equity is shares. And so you have about 6 asset classes. Then you split your allocations. Maybe you put 20% in FDs. Oh, let's say it is 30% in FDs, 20% in fixed income, another 20% in real estate, maybe 20% in equity, precious metals maybe 5%, and the balance 5% in unit trusts. Right, so that's how you are planning to allocate the 100 million. Now, once unit trust, you can invest in various companies, right? So there are various unit trusts. Instead of pooling the 5 million in one unit trust, you can split it maybe amongst 5 unit trusts, right? I'm not going to give you names, but there are several unit trust management companies. If you take the newspapers, these unit trusts publish their price every day. It's a regulation by the SEC. You can check their prices and invest. The real estate, you won't buy one single property in a certain area, right? Maybe you can buy urban or suburbs. Then amongst this, you can split it again, maybe industrial or residential, likewise. So you can have various categories. And again, you can split the 20% according to that. In FDs, you can have in several banks. And for various tenors. It can be long term, medium term, or short term. This might be long term, might be 5 years. Medium term is 2 to 5 years. Short term, less than 1 year. Fixed income, you can invest in government securities, treasury bills or bonds, or corporate debt. Corporate debt could be either investment grade or non-investment. Then you can have HTM portfolio or rating, or even an OCI portfolio. Remember IFRS 9? Metals, you can have gold, silver, platinum, and all that. Equity, you can have you can invest in maybe large caps, mid caps, and small caps. Large caps are where you have market capitalization of more than I think it's 500 million. Mid cap is between 100 to 500, and less than 100 is small caps, like something like that. But based on market capitalization, you can split it. You can have your own segregations for large, medium, and small caps. So likewise, the idea is to split it amongst several asset classes. Now, why will you do all this? Why go through all this hassle? Why not invest the entire 100% in treasury bills? The entire 100 million in treasury bills or treasury bonds. Why not do that, and why go through all this trouble? Now, the classic example I can give you is if you take a cricket team, right? It has 11 players. A cricket team will not have 11 batsmen. It will not have 11 bowlers or 11 wicket keepers. Why is that? Why can't you have 11 batsmen? It's not that you can't have, you can have if you want, but if you have 11 batsmen, there is no one to bowl. If you have 11 bowlers, there is no one to bat. 11 guys who can only field, there is no one to bat or bowl. Right? So what is the thinking behind this? Why is this? Because you need to manage exposures or risk. Right? The thinking behind this is risk management. To manage risk properly, you need to have various kinds of assets. Right? You can't have one single asset and depend entirely on it. Now, if you depend 100% on batsmen, right? If a cricket team depends 100% on batsmen, and if all the batsmen fail, then there is no one to bowl. you get hammered. Likewise, if you depend 100% on bowlers and all the bowlers have a bad day, there is no one to rescue. There are no batsmen to rescue. So you can't depend entirely on bowlers as well. So likewise, if there is a loss in any of these assets, right? For example, if this is the height of subprime mortgage crisis, real estate prices will start crashing. And if you had invested 100% in real estate, then you will lose a lot of money. Now, look at what happened just before the lockdown. At the beginning of this year, Sri Lanka's S&P, all share index was at 6,200. So first, then by the 12th of May, it fell all the way down to about 4,200. So that's a 30% drop in the stock market. The stock market dropped by about 30%. 30% down. Meaning if you had invested $100 at the beginning of the year, within 5 months you'll be left only with 70. Huge loss. So 100% if you had invested this entire 100 million in the share market, you would have lost 30%. 30% of your wealth would have got wiped out. Right? It has now recovered. About 50% of the drop has been recovered. The index is at about 5,300. So about 50% of the loss has been recovered. But still, you will be negative 15%. You invest 100, you will be now at 85. Huge loss. So investments don't work like that. You can't invest in that manner. So you can't invest in one single asset. You have to split it amongst various assets. That is, the objective is to manage risks. Okay, so that is the basic thinking behind this. The next chapter that we are going to cover. It's called portfolio theory. Now, this is how you manage a portfolio of 100 million. Yeah. Regardless of the amount, whether it's 1 million, 100 million, 1 billion, 10 billion, 100 billion, this is what you need to do. You need to invest in various assets, right? So this investing process in various assets is called diversification. So the idea is, if you invest in one type of asset, if that asset has a loss, the loss can be cushioned by the gains that other assets make. Right. Okay, so this is the idea. You need to invest in various types of assets, right? Even amongst the assets, you need to split it further down. That is the basic thinking behind it, right? I hope this is understood. So, any questions on this? Up to now, any questions? Modern portfolio theory, right? So, portfolio is a collection of assets. A portfolio of assets, the aim is typically to maximize expected return for a given amount of risk, right? So, for a given amount of risk, remember, risk is measured by standard deviation. Standard deviation measures risk. For a given amount of risk, your objective is to maximize the return and to minimize the risk for a given level of expected return. Then, for a given level of return, you need to minimize the risk. Now, for example, if I put it this way, right? If government bonds so treasury bills, for example, 1 year is giving you a return, let's say, of 5%, right? And a 1 year bank FD is also 5%, or let's say a finance company. Finance company FD is also giving 5% for the same 1 year. Where will you put your money? What are your thoughts? Where will you invest? You understood the question? If a 1-year government treasury bill is giving you 5%, 1-year finance company FD is also giving you 5%, you will obviously invest in the government treasury bill. Why is that? For a given amount of risk, return, right? For a given amount of return of 5%, you go for the investment which has the lower risk, right? You don't invest in the investment which offers a higher risk. So you go for the lower risk for a given amount of return. That is what a rational investor would do. If you are in sound mind, that is what you will do. You will invest for a given return in the minimum risk, right? Then, let's say a 1-year FD. In a bank is 6%. 5-year FD is in the same bank. Sorry, let's say it's a treasury bill. I'll put it this way. It's a 2-year treasury bond giving you 6%. Then a 5-year treasury bond is giving you 5%. Right? So both of these issued by the government. The government has issued. Now where will you invest? The government has issued a 2-year treasury bond, that's 6%. 5-year treasury bond, 5%. Where will you invest? Both issued by the government. You will invest in the 2-year. Yes, correct. Why? Reason is now both of these investments, securities, the treasury bonds have been issued by the government. So the risk is the same. Right, same risk. You're investing in the highest return. Yeah. For a given amount of risk, you need to invest in the highest return. Right? For a given amount of return, you need to invest in the lower risk. But for a given amount of risk, you need to invest in the higher return. Right? So that is what a rational investor would do. Unless you are insane, you will not invest in the other option. Right? If this is the case, both the government treasury bill and finance company FDs are 5%. You will not invest in the finance company unless you are out of your mind. Now, for this finance company FD to become attractive, for it to make sense for you to invest there, it has to offer something on top of the 5%. Maybe a rate of 8% or 9%. Right? So if this happens, the extra 3% that you get is called the risk premium. Risk premium of 3%. Finance companies offer a risk premium of 3% in this case. Right? So unless you get a premium, you will not invest in the high risk option unless you get a premium. Right? So I hope that is clear. That is what is addressed in the last slide. So you maximize the expected return for a given amount of risk or minimize the risk for a given level of expected return. By carefully choosing the option, the proportions of various assets. However, the basic assumption of modern portfolio theory has been widely challenged by fields such as behavioral economics. And behavioral economics. Now, that is the latest theory, behavioral science, which means behavioral economics says that not all investors are rational. Not everyone is rational. Right? There are some investors who are also irrational. They don't always make rational decisions. They might make irrational decisions because there are various types of investors that is governed by their behavior. It's based on a science called behavioral economics, right? According to behavioral economics, there are 4 types of investors. 4 types of investors. Behavioral economics, it deals with how investors think, the psychology of an investor. Right? So some investors might be methodical. Methodical investors. Right? Now these guys make decisions methodically, as the name implies. Right? Then you can have ad hoc investors. So they wake up in the morning and they only decide where to invest. They make ad hoc decisions. Yeah. Cautious investors. They don't want to take any chance. Even if a finance company offers 8% for 1 year, they will not invest. They will still prefer to invest in the low return. Cautious investors. You also have guys called individuals. Individualist investors. So individualist, they will do their own research. They don't want to depend on anyone else. They will make their own decisions. They are not necessarily guided by the research done by others. They will do their own research and they will make their own investments. They don't depend on others. So these are the kinds of investors. Okay. It's difficult to say that this method is the best. One method might be preferred over the other by investors. Depends on the kinds of investors. Right? So what this theory says is behavioral economics now takes precedence over modern portfolio theory. Right? So it's a new area. Risk. 2 types of risk. Systematic risk and unsystematic risk. Systematic risk and unsystematic risk. The risk inherent in the entire market or an entire market segment and not just a particular stock or industry is called systematic risk. So the risk within the system is called systematic risk. Now, something like COVID. The market, remember, the stock market crashed by 30%. So that is something within the system. It's not something unique to a particular stock. The entire market crashed. So that's called systematic risk. This type of risk is both unpredictable and impossible to completely avoid. You cannot avoid. You don't know it is coming. It hits the entire system at once. It cannot be mitigated through diversification. Remember, that's the most important thing in this. Systematic risk cannot be minimized by diversification. So investing in various assets will not save you from systematic risk. Will not give a cushion from systematic risk. Only through hedging or by using the right asset allocation strategy. So what you should have done is you may have purchased an option, maybe a put option to sell shares if they fall. So you can hedge, but you can't diversify. Or during a crisis such as this, you should have invested maybe in an asset like gold, which appreciates in value during a crisis. Right, so your allocation, 5% allocation for gold should have been increased to 10-15%. That is the only way to minimize systematic risk. The other type is called unsystematic risk. A risk which is applicable to a given stock is called unsystematic risk, right? Now, recently, I think last week, there were talks that beef imports to the country will be banned. Sorry, not beef imports, but the cattle slaughter in the country will be banned. Now, if there were companies that were in the beef industry in the country listed in the stock market, they would have taken a beating. That is called unsystematic risk. The risk that applies to one single company, right? Now the airports remain closed, so the tourism sector, the hotel sector has taken a beating. That is called unsystematic risk. Risk that is applicable only to a particular company or sector. Unsystematic risk is a company or industry-specific risk that is inherent in each investment. Unknown unsystematic risk can be reduced through diversification. Remember, risk can either be systematic or unsystematic. Right? Systematic risk cannot be diversified. You can only hedge or change allocation. Whereas unsystematic risk can be diversified. Okay, so this is the most important thing. Systematic risk, you cannot diversify. Unsystematic risk, you can diversify. And now, because it's a systematic risk, if you are invested in stock market or the real estate market or bonds, right? It's still within the system, so it cannot be diversified because the entire market has crashed. Okay. Now this risk and return profile, if you plot your returns against the number of securities, right? It's not the return, actually, it's the risk. You are plotting the portfolio variance or the risk, in other words. So what it means is, if you plot this is, in other words, the risk against the number of securities. And so if you have just one security in 100 million portfolio, what we did earlier, just one security, right? Let's say 100% invested in equity. 100% in equity. What it says is, if you invest your entire portfolio in one security only, your risk will be very high risk. Or 100% in real estate, still high risk. 100% in fixed income, high risk. 100% in gold, still high risk. Now, if you invest, say 50% in equity, 50% in fixed income, your risk will reduce by a lot. Right? And if you invest it further down, 25% equity, 25% fixed income, 25% real estate, and 25% in gold, your risk will reduce further. Likewise, if you increase the number of securities, right, you put in a trust and keep increasing the number of securities in the portfolio, your risk will reduce. It will continue to reduce until a certain level. On this level up to which it reduces is called the unsystematic risk. What you cannot reduce is called systematic risk. So this is how you segregate systematic and unsystematic risk. There is a certain element which cannot be reduced through diversification. And as you increase the number of securities in your portfolio, like as you keep adding securities to the portfolio, diversification benefits increase, meaning your risk will reduce significantly, right? But not beyond a certain level. That level is called systematic risk. And any risk on top of systematic risk is called unsystematic. So your total risk is the systematic risk your total risk is the systematic risk plus unsystematic risk. Okay, so I hope this is clear. Beyond a certain level, you cannot reduce risk. That level is called systematic risk. Now, you can reduce risk by increasing the number of securities in the portfolio. The more securities you have, the better diversified you are. So, ideally, they say it's about 10 to 15 securities maximum. Right? Beyond that, it becomes very inefficient. It's difficult to monitor everything. So, ideally, you should have 10 to 15 securities in the portfolio, not beyond that. To have an efficient portfolio, it is about 10 to 15 securities. Diversification is a risk management technique that mixes investments within a portfolio based on the premise that a portfolio of different kinds of investments will pose lower risk than any individual investment found within the portfolio. So it's a risk management technique that mixes investments within a portfolio based on the premise that a portfolio with different kind of investments. So you need to have different kind of investments will pose a lower risk than any individual investment found within the portfolio. Right, so various investments, investing in various kinds of assets will give you lower total risk than investing in one particular asset. Diversification strives to smooth out unsystematic risk. So unsystematic risk can be minimized in a portfolio so that the positive performance of some investments will neutralize the negative performance of others. So some will give you positive performance, others will give negative performance. Everything will not perform to the same level. Benefits of diversification will hold only if securities in the portfolio are not perfectly correlated. Very important point. For you to have diversification benefits, you need to have a portfolio which is not perfectly correlated. It's a correlation, very important term. Now, what is correlation? Correlation measures the strength of a relationship measured by correlation. Now, for example, if you all are married, whenever you say yes, if your wife also says yes, that means perfect positive correlation. Whenever you say yes, your wife says no, or when you say no, your wife says yes, it is perfect negative correlation. Remember, perfect positive is where when you say yes, your wife says yes. When you say no, your wife says no. That's perfect positive. Perfect negative is when you say yes, wife says no. When you say no, wife says yes. Perfect negative. Then when you say something, whether yes or no, you don't know what the wife is going to say. That means there is no correlation. Okay, so that's correlation. Perfect positive, perfect negative. It goes between perfect positive to perfect negative. Perfect negative and perfect positive. Perfect negative correlation is -1. Perfect positive is correlation +1. There's a correlation can vary between -1 to +1. Right, so -1 is called perfect negative, +1 perfect positive. In between you have 0, which means there is no correlation. Okay, so I hope clear. Combining assets with low, zero, and negative correlations. Combining assets with low, zero, or less than perfect positive. It is possible to derive portfolios that have lower risk than either single asset. If you have assets, anything that is less than perfect positive, and anything that is less than 1, with correlations of less than 1, you will have diversification benefits. A diversification benefit is a reduction in portfolio standard deviation without an accompanying decrease in expected return. So remember that the good thing about diversification is even if you diversify, you will have a drop in risk without a drop in return. So there is no drop in return. You don't have to worry about that. But the benefit is you will have a drop in risk. Overall drop in risk without a drop in return. Right? That's called diversification. Right. So modern portfolio theory is a mathematical formulation of the concept of diversification in investing, with the aim of selecting a collection of assets that collectively has lower risk than any individual asset. Right? So you need to select a collection of assets that collectively has lower risk than any individual asset. Collectively, all assets should have lower risk than any single asset. Right? If you had, let's say, the cricket team example, all batsmen of the same kind, all like Sanat Jaiswal. Right? So collectively, one type of asset. Now having that, is riskier than having a set of cricketers with various talents, right? So you should have other cricketers also, other kinds of cricketers like the Marmons, Mahelas, Sangas, Muralis, Vas. All these kind of cricketers should be there for the collective risk to be lower than one single risk. Okay, so model portfolio theory aims to select a collection of assets that collectively has lower risk than any individual asset. How it works? It aims to reduce risk by diversifying. So model portfolio theory aims to reduce risk by diversifying. Different types of assets often change in value in opposite ways. A correlation, if it's less than perfect, so if real estates go and let's say real estates and treasury bill yields, right? Or treasury bills. If real estate prices are going up, treasury bill prices are coming down, that means there's negative correlation. Prices in the stock market move differently from prices in the bond market. A collection of types of assets can, in theory, face lower overall risk than individual. Collection of both types of assets can, in theory, face lower overall risk than individual. That's the most important thing. Diversification lowers risk, right? Very important point. Diversification will reduce risk, even if asset returns are not negatively correlated. You don't have to have negative correlations. Very good if you have negative correlation, but for as long as the correlation is not perfect positive, you will have diversification, even if they're positively correlated. Right? Anything less than perfect positive will give you diversification benefits. Okay, so that is how diversification works. Anything less than perfect positive you should have. So perfect positive correlation, remember, will not give you diversification. Perfect positive, there is no diversification. Anything less than this will give you diversification. Perfect negative gives maximum diversification. Yeah. The basics of modern portfolio theory. Modern portfolio theory models an asset's return as a normally distributed function, right? So it's like a bell curve. It assumes an asset's return is like a normally distributed function. By the way, correlation can be either perfect positive or perfect negative or somewhere in between. But let's say there are two assets, right? Let's say bond prices and equity returns. Now, if these are perfect negative today, next year there is nothing that says that the correlation can change to perfect positive. Right? So what is negative this year might be positive next year. It doesn't remain the same. That's the important thing to remember. Which means you need to keep monitoring the correlation. The correlation is going from negative to positive, positive to negative, or is it going to perfect positive? If perfect positive, then you should sell one asset off and buy another asset which is not perfect positive. Right? So correlation does not remain the same. It keeps changing. From time to time, it changes. Almost every day, every month, every week, it changes. So remember, it's important that you keep monitoring the correlation amongst assets. It defines risk as the standard deviation of modern portfolio theory models and assets return as a normal distributed function, and it defines return as standard deviation of returns, right? It defines risk as the standard deviation of returns. Risk is the standard deviation of a return. It models a portfolio as a weighted combination of assets. Right? Portfolio is a weighted combination of various assets. Hence, the portfolio return is the weighted combination of the assets return. Okay. Portfolio return is the weighted combination of the assets return. Any questions up to now? Combining different assets whose returns are not perfectly positively correlated seeks to reduce the total variance of the portfolio return. Right? So when you put various kinds of assets together, like real estate, equity, fixed income, gold, unit trust, all these kinds of assets together, when you put them together, if the correlation is not perfect positive, it reduces the total variance of the portfolio. It assumes that investors are rational and markets are efficient. It assumes that investors are rational investors and efficient markets. So investors think rationally, logically, and efficient markets. Markets are efficient. Right? So rational investors, meaning investors return. A rational investor would invest at, remember what we discussed, the highest return for a given risk or the lowest risk for a given return. Right? That's a rational investor. And what do you mean by an efficient market? What is an efficient market? What are efficient markets? Give me features of efficient markets. How would you identify an efficient market? Any idea? Features of an efficient market. How do you identify efficient markets? What about transaction costs? Transaction costs are high or low? Would efficient markets have high transaction costs or low transaction costs? Like brokerage or not? Low transaction costs, yes. What else? Low taxes. Market should be deep and broad. The deep market means it should have plenty of liquidity. And also choices. Right? If you have only one share listed in the stock market, there is no choice. The market is narrow. It's not broad. Only John Keats in the share market is not going to help. You should have different choices. Options to invest in various types of assets. Also, should be liquid. Then there should be information efficiencies. Information should be symmetric. Everyone should have the same kind of information. There shouldn't be insider trading and all that. Right. Criticisms of modern portfolio theory. Financial returns do not follow a Gaussian distribution or any symmetric distribution, meaning returns are not always a bell curve, right? It can be different. So returns need not be a bell curve always, right? This is called the Gaussian distribution, which may not be the case. Right? You can have various types of returns. Skewed return, like this. Or like this. Also possible. Okay, so bell curve is not a must. Correlation between asset classes are not fixed, but can vary depending on external events, especially in crisis. Like there's a crisis called like COVID. All the markets in the world crashed, right? So but these days, different markets are moving different ways. Correlations are not fixed. Growing evidence that investors are not rational and markets are not efficient. Behavioral economics, it's overriding the weightage on portfolio theory. Right, so not all investors are efficient, are rational, and not all markets are efficient. Right. So modern portfolio theory will be discussing Markowitz portfolio theory. Right. On asset allocation, an asset class is assets with similar characteristics, attributes, and risk-return relationships. Right. So assets with similar attributes, like currencies, you have sterling, Australian dollar, New Zealand dollar, Canadian dollar, US dollar, currencies. Those are currencies. See, bonds, government bonds, maybe treasury bills bonds, equities, real estate. It's similar characteristics in each of these assets. They're called asset classes. Asset allocation is the process of dividing a portfolio among major asset categories such as bonds, stocks, or cash. The purpose of asset allocation is to reduce risk by diversifying the portfolio. Asset allocation tries to reduce risk by diversifying the portfolio. The idea of asset allocation differs based on the risk tolerance of the investor. Right? So the investor will have a risk tolerance based on so risk tolerance an investor's risk tolerance will be based on his ability and willingness to take risk, right? So his ability is high and willingness is high. His ability is high, willingness also high, then his risk tolerance will be high. Ability is high. This is medium. Risk tolerance will be medium. And ability high. Willingness is low. His risk tolerance will be low. Because your ability can be either high, medium, or low. Right? Willingness can also be high, medium, or low. So whatever the criteria, if you can have high ability, low willingness. Maybe a person who is super rich, someone like Jeff Bezos, who is the richest man in the world, but he doesn't want to take risks, something like that. So in that case, ability is high, willingness is low, you have low risk tolerance, right? You go with the lower level. Purpose of asset allocation is to reduce risk by diversifying the portfolio. The ideal asset allocation differs based on the risk tolerance of the investor. Risk aversion is an investor's general desire to avoid participation in risky behavior. In this case, risky investments. Like what we discussed at the beginning, right? If you have a given amount of return, you go for the low risk. Or for a given amount of risk, you try to seek the highest return. That's called risk aversion. It's not avoiding risk. It's about maximizing the efficiency of risk. Investors typically wish to maximize their return with the least amount of risk possible. Maximum return for given amount of risk. When faced with two different investment opportunities with similar returns, a rational investor will choose the investment with the least risk, right? So two investments with a given amount of return, you go for the return with the lower risk. If you're rational. Or if you're averse, risk averse. Now the next diagram is very interesting. An efficient portfolio is a portfolio that offers the highest expected return for a given level of risk, as measured by the variance or standard deviation of return. Now, can you all analyze these three? These are three portfolios, right? A, B, and C are different portfolios. Now, within the portfolio, you might have a combination of assets, right? So, A might have. Let me explain. Let's assume there are 4 types of asset classes in each portfolio. Maybe real estate, fixed income, equity, commodities. Right. So let's say you have different combinations. Real estate, let's say there is one portfolio, 25% real estate, 25% fixed income, 25% equity, 25% commodities. Right. This one, let's assume is A. Then there is another portfolio which has 30% real estate, 20% fixed income, 30% equity, 20% commodities. That is B. Another portfolio which has 20% real estate, 30% fixed income, 20% equity, 30% commodities in various combinations, right? A, B, and C. Out of A, you have been given the return against standard deviation. Remember, standard deviation is a measure of risk, right? So, given these 3 portfolios, given given these three portfolios, which one will you pick? A, B, or C, and why? Okay. So that is the question. Can you all think about it? What will you do if you are the fund manager? Where will you invest? In A, B, or C? And justify it in the risk versus return graph. So if I plot the graph, we have expected return against standard deviation, which is, in other words, the risk, right? So you have been given A being here, this is B, and have C. Right? So these are the three portfolios. Now, how would you put things in perspective and pick which portfolio? Where will you invest? Ezra says, because real estate and equities carry low risk than FIS and commodities. Right. But remember, now we are combining. Huh? You're combining in various combinations. So you're not investing entirely in real estate or fixed income. You have different combinations which gives you various return and risk points of view. And various returns and risk. So there are three portfolios giving you various combinations of return and risk. This is your return, and here you have the risk, right, which is measured by standard deviation. Okay. Where will you invest? In B. Atom will invest in B. Ezra will be investing in B. Okay, so everyone wants B. Right, so this is the winner. Everyone is going to invest here, is it? Anyone with opposing views? Anyone in disagreement? Vishwa will invest in C. That's all. No one wants A. A is nobody's baby. Right. Let's look at it this way. Now between A and B, right, A and B, which one will you prefer? A and B. Between A and B, which one will you prefer? You prefer A or B? What do you think? Between A and B, which one will you prefer? Which one will prefer A? Why? Reason? Yes, you're right. Absolutely right. If you take A and B, A and B, they have the same return, no? Same return, but risk, A has low risk. So between A and B, you will prefer B. You don't want B. You will want to invest in A but not in B. So what about B and C? Between B and C, because A and B you will get the same return. A has low risk, B has higher risk. So between A and B, you need to select same return. You go for the asset, the portfolio which gives the low risk. And so it's A. The B and C, between B and C, which one will you prefer? Between B and C. You prefer C. The reason? Yes, Radha, what is the reason? Thinking behind it. Between B and C, you prefer C. You're right. You need C and not B. Okay. Because you get these are the same risk. B and C carry the same risk. Okay. But C has a higher return. So same risk, you go for the portfolio which gives the higher return. Right? So you invest in C, not in B. And no one wants B. B is nobody's baby. Nobody's baby. You will either invest in A or C. So it has to be either A or C, not B. B needs to be avoided. So that is risk aversion. Risk and return. Your return is simply the ending value minus the beginning value plus any cash flows divided by the beginning value. Right? So if you had invested $100 after 1 year, you're selling it, let's say, for 95. Right? And in between, you get maybe dividends of 10. The dividends can be your cash flow. Here is your beginning value. This is the ending value. Your return will be the ending value minus beginning value plus cash flows divided by the beginning value. That is your return on investment. It will be 95 minus 100 plus 10 divided by 100. Five over 100 is a return of 5%. Right? That's how you calculate your return. Then if you have probability weighted returns, right? So for example, if you have, let's say, invested in stocks and looking at the past history, past trends, if that particular stock has a 10% chance of giving a 5% return, 50% chance of a 10% return, and a 30% chance of a 20% return, 10% chance of a 30% return, right? So these probabilities of the particular stock, let's assume it is John Hills, is given. You make there's a 10% probability that you will end up with a 5% return, 50% probability that it will give a 10% return, 30% probability that it will give 20% return, 10% probability that it will give 30% return. So this probability and return combinations are given. Then what is your expected return? How do you calculate expected return? You need to multiply probability. So you have been given various probability and return combinations. 10% probability that it will give 5% return, 50% probability of giving a 10% return, 30% probability of a 20% return, 10% probability of 30% return. Right? So under these situations, what you need to do is you need to calculate the probability into return. So it's 10% into 5%, 50% into 10%, 30% into 20%, 10% into 30%. This is 5%. This is 6%. Here you have 3%. (0.5%). Right. That probability into return, and you need to add these up. 14.5%. That is your expected return. Is going to be 14.5%. It will give an expected return of 14.5%. Right. That is what it means. Your expected return is the multiplication of probability into your return. Is total of 14.5% expected return. Right. So that's what this equation tells us. Can you try the next table? The table that is given. Answer is also given, but try it on your own. On the probability and the expected returns. And the returns are different, but the calculation is the same. Its probability is given as 10%, then you have 25, 40, and 20. And the return combinations are also different. Have 5, 10, 15, 20, and 30. The probability into return will be 10% to 5%. Here it is 25% to 10%, 40% to 15%, 20% to 20%, 5% to 30%. So given this probability of return combinations, you need to multiply the probability into return. Then you will get 0.5%, 2.5%, 6%, 4%, and 1.5%. Right. The total of probability to return is 14.5%. Yes, I hope this is clear. Did you get 14.5? So let's try another example. What happens if you add up all the probabilities? Add up all the probabilities. How much do you get? How much should you get if you add up all the probabilities? You should get 100%. Yes, it should be 100%. Right. Now, what is your expected return? How much? Can you calculate? Okay. Right. So 10% into 0. You get 10% into 0%. Okay. 20% into 5%. 20% into 10%. 20% into 15%. 20% into 20%. And 10% into 25%. this is 0, 1, 2, 3, 4, 2.5. Yes, it comes to 12.5%. Right? All right. So I hope it's clear. Any questions? An expected return. Okay. Now what if these probabilities, well, let me put it this way, these were the weights, right? Weights, which means 10% of your assets, 10% of your assets are giving a 0% return. Right? 10% of your assets will give 0% return. 20% of your assets will give a 5% return. Like 20% of your assets give a 5% return. Then another 20% of your assets give a 10% return. And 20% of your assets give a 15% return. A further 20% will give a 20% return. And you have 10% of assets which give 25% return. Right? So these are your weights. How you have invested in various assets which gives various combinations, various returns. Right? If that is the case, how do you calculate expected return? It's the same calculation, same. What you do is instead of probability, you need to use the weight to the return. Weight into return, right? So it's 10% of your assets giving 0% return, 20% of assets giving 5% return, 20% of assets giving 10% return, 20% of assets giving 15% return, 20% of assets giving 20% return, 10% of assets giving 25% return. Same calculation. And you end up with a 12.5% expected return based on these weights. Right. So that's how it works. Same calculation. You don't have to do anything else to memorize. Yeah. Okay, so what is risk? How would you define risk? The next area is on risk, right? So we did returns. The next area is on risk. Risk is the uncertainty of future outcomes. It's a probability of an adverse outcome. Right? The future is uncertain. You don't know what is going to happen, and the probability of something bad happening. Okay. Now, for example, let's say the future is uncertain. You don't know, there might be a tsunami. But what is the probability of this happening? Is the risk. Risk aversion, given a choice between two assets, what we did earlier, choice between two assets with equal returns, the investors will select the asset with a lower level of risk. Right? So if two assets give same return, you will go for the asset which gives the highest return. Higher the risk, higher the return. Variance is a measure of risk. Variance of the rate of expected return for an individual asset is given by It's the two returns, the return minus the average return squared into probability, right? So you don't have to memorize this. This is only for your knowledge. Okay. But if you have done statistics, this might make sense to you. Otherwise, don't waste a lot of time on this. But what you need to know is variance. It's a square of risk, right? Sigma squared. Sigma is standard deviation. Sigma is the standard deviation. Sigma squared. What does standard deviation measure? If you have to remember, it measures risk. Sigma squared is variance. So, in other words, variance is also a measure of risk. Okay. Standard deviation is a measure of the dispersion of a set of data from its mean. Standard deviation. Remember, last week we did Z scores. The Z score is here. It's sorry. Z score is 1.65 if the confidence level is 95%, and Z is 2.33 if the confidence is 99%, right? So how far this is the mean, the average. How far dispersed are these? That is what standard deviation measures. The further out it is, the higher the standard deviation or the risk. So standard deviation is a measure of dispersion of a set of data, from its mean. The more spread apart the data, right? The further apart you are, the higher the deviation. Standard deviation is calculated as square root of variance. Square root of variance is the standard deviation. Is applied to the annual rate of return of an investment to measure the investment's volatility. Right? So the standard deviation is applied to the annual rate of return of an investment to measure volatility. So using this data, the annual returns of a set of data, you can calculate volatility. Now, what happens if you combine two assets in a portfolio? How do you measure risk? And if you have one asset, it's very easy. Standard deviation will measure risk. But when you put two assets together, the risk profile changes because each asset will have its own risk. Then how do you calculate the total risk of the portfolio? Using this equation. So W is the weight of each asset. You add W1 plus W2 is 100%. Right. So for example, if you have fixed income and equity, two assets in a portfolio, fixed income weight, return, and here you have standard deviation. Fixed income, let's say the weight is 40%, return is 10%, standard deviation 5%, right? Equity, you might have the balance 60%. So this is W1. This is W. Return and the standard deviations of each asset, right? So this is asset 1. Therefore, this is W1. This is return 1. Standard deviation 1. The return on equity might be 15%, standard deviation 10%. This is W2, return 2, standard deviation 2. Okay, so if you add W1 plus W2, W1 plus W2 is 40% plus 60% gives you the 100%. Okay. So W1 sigma 1 is 40% into sigma 1, 40% into 5%. Square plus 60% into 10%. Square plus R is the correlation between these two. The correlation between fixed income and equity, let's say it's 0.5, positive 0.5. W1, 40%, sigma 1, 5%, 5 times 60% into 10%. If you solve this, you will get the total variance of the portfolio. Right? Now, what happens if the correlation is perfect negative? What if it's perfect negative? What happens to this equation if correlation is perfect negative? Then sigma square is W1 sigma 1 square plus W2 sigma 2 square minus 2 W1 sigma 1 W2 sigma 2. Right. This is nothing but W1 sigma 1 minus W2 sigma 2 squared. Grade 2. Remember, you have A squared plus B squared minus 2AB is A minus B squared, right? Based on that, you get this. So what if correlation is 0? Then this becomes sigma square is W1 sigma 1 squared plus W2 sigma 2 squared. And R is 0, this entire thing becomes 0. Right? So plus 0, you will end up with W1 sigma 1 plus W2 sigma 2 squared. Then R is plus 1. Sigma squared is W1 sigma 1 squared plus W2 sigma 2 squared plus 2. R is 1. So it's W1 sigma 1 into W2 sigma 2. This is W1 sigma 1 plus W2 sigma 2 squared. Again, grade 2, A plus B squared is A squared plus B squared plus 2AB. Okay. This is the same principle. It is. Okay. Now, if you look at these three scenarios, your risk is lowest when the correlation is -1. When there is when the correlation is +1, the risk is the highest. Okay. So that's how it works. Now let's try this example. Can you calculate expected return and standard deviation for this portfolio? Expected return and the standard deviation of this portfolio. Please calculate. Okay. So you have bonds and stocks. 75 million. And these are the weights. This is W1. Stocks you have 25 million. 25 million. So W1 is 75%. W2 is 25%. Right. So out of a total of 100, you have 75 in bonds, 25 in stocks. Returns 12% and 18%. These are R1 and R2. Standard deviations 20% and 40%. Sigma 1, sigma 2. Right? So the expected return is W1 R1 plus W2 R2. W1 is 75% into R1. %, plus 25% to R2 is, sorry, R1 is 12%. R2 is 18%. So this is 3% plus 4.5. Sorry, it's 9% plus 4.5. 13.5%. So you got the returns right? This is your expected return. Then what about the standard deviation? W1 sigma 1 square plus W2 sigma 2 square plus, and your correlation is .9. Right? So it's positive, strong positive, but not perfect positive. So W1 sigma 1 into W2 sigma 2. W1 is 75% into sigma 1 20% square plus W2 25% into 40% square plus 2 into 0.9 into W1 is 75% into 20% times 25% into 40%. So it is 15% square plus 10% square plus 2 times 0.9 is 1.8. Into 2% into 10%. That is 15% square plus 10% square plus 2.7% square. Sorry, 27% square. That is actually 270%. My mistake. Has to be 270% square. So 225% square plus 100% square plus 270% square comes to 325 plus 270 and 95% square. Right? That is your variance. Therefore, your standard deviation is the square root of 595. Yes, you're perfect, 24.4%. Right. Okay, Isra has a question. When a sum comes like this, the equation decided according to correlation. Yes, you're right. The correlation is positive, the first formula, and if the correlation is negative, for the second formula. No, you will get only two assets, so the correlation for that will be fixed. Right. So if you are combining various assets only, you'll get positive and negative correlations. But for two given assets, usually the correlation will be fixed. What are the situations we use expected return also? Question is not very clear. What are the situations we use? R is when you're forecasting a return, maybe you're forecasting a return for your bond portfolio for the next year, right? So when you use forecast only, you use expected return, right? Steps to building a profitable portfolio. Determine the appropriate asset allocation for you. So you need to ascertain your financial position, your investment goals, age, purpose, how much time you plan to grow your investment, what is the time period you are looking at, the amount of capital that you're going to invest, and the future capital needs. Correlation is the covariance divided by the two standard deviations of the portfolio. Correct? Correlation gives the strength of the relationship. Then again, going back to the steps to building profitable portfolio, personality and risk tolerance, right? High degree of risk, which we discussed earlier, you wish to take for the possibility of greater returns. How much of risk are you willing to take? The risk tolerance. Limit, if any, given to you by the board or the management, right? What is the risk given by the board? These are important criteria to determine how your investment should be allocated among different asset classes. The possibility of greater return comes at the expense of greater risk. So higher the return, higher the risk. You want to eliminate risk, settling down to low returns. So you try to minimize risk and settle down to low risk. Or you want to optimize for unique condition and style. Then the risk return trade-off, low level of return, lower the level of return, right? So low return, low risk, low return, low risk, low return, high risk, high return. That is called the risk return trade-off. The risk tolerance differs from person to person depending on goals, income, and personal situation. Determine what kind of risk level is most appropriate is in the ACA because it changes from person to person. Investors still face a substantial great risk and volatility to get an overall return that is higher than predictable government securities, which is a tough thing. So risk return trade-off is the balance between the desire for lowest possible risk and highest possible return. It's value trade-off between low risk, low return, high risk, high return. Where are you going to settle in between? That's called the risk return trade-off. Right. Capital asset pricing model. This area we will cover next week.